Warren Buffett sits on a net worth of over $100 billion. To reach that level of extreme wealth, you usually have to inherit a corporate empire or engineer a massive leap in consumer technology. Buffett did neither. Instead, he chose one of the most unpredictable environments on Earth to build his fortune. He relied entirely on the stock market, a chaotic arena where the vast majority of people lose their savings trying to time the next big jump. But his long-term success isn't the result of a crystal ball. He built a contrarian mathematical system. While everyone else tries to guess what a company will do tomorrow, Buffett focuses obsessively on exactly what it is worth today. His worldview was shaped early on. Born in Omaha in 1930, his earliest memories were formed right in the middle of the Great Depression. Watching his neighbors struggle to survive left him with an enduring respect for the mechanics of money and an intense fear of losing it. By the time he was 6 years old, he was already experimenting with profit margins. He'd buy 6 packs of Coca-Cola from his grandfather's grocery store and sell them door to door around the neighborhood, pocketing a 5-cent profit for every pack. 5 years later, at age 11, he took all his childhood savings and bought 3 shares of an oil and gas company called City Service at $38 apiece. Almost immediately, the price dropped to $27. Panicking, he held on just long enough for the stock to recover to $40 and then sold his shares. A few months later, that exact same stock shot up to over $200. That early sting taught him a lesson he carries to this day. The daily emotional swings of the market are highly irrational. Trying to play the short game of timing the peaks and valleys is a fool's errand. True wealth requires a disciplined, long-term approach. To formalize that approach, he eventually enrolled at Columbia Business School to study under economist Benjamin Graham. Graham gave Buffett the strict mathematical framework he had been looking for. This diagram represents Graham's cigar butt philosophy. The strategy is to find a business that is performing terribly, but is priced so far below its actual worth that if you bought the entire company and immediately liquidated it, the scrap parts would sell for more than what you paid. It's like finding a discarded cigar on the street. It might be gross, but there's a free puff of profit left inside. Over the next 6 years, Buffett applied this exact logic with his own investment partnership. By continually buying undervalued, failing companies and cashing out that built-in margin of safety, he generated a 29% annual return, outperforming the broader market by a factor of 4. But by 1969, the strategy stopped working. A massive bull market had driven stock prices wildly high. Almost every company was overvalued. The cigar butts had dried up. Fearful of losing his partner's money in a speculative bubble, Buffett dissolved his entire business and gave everyone their money back. Most investors would have tweaked their models or taken bigger risks to keep the fees rolling in. Buffett simply walked away. He refused to force a specific strategy into a market that no longer supported it. He did, however, keep his personal investments, which included a dying textile mill called Berkshire Hathaway. He had originally bought shares in it as a cheap cigar butt play, but after the owner tried to cheat him out of 12 cents a share on a tender offer, an infuriated Buffett bought the entire company just to fire him. Now he was stuck managing a heavily declining business. It was his close business partner, Charlie Munger, who helped him see a way out. Munger convinced him that the era of buying cheap, terrible companies was over. Instead, they needed to pivot toward buying high-quality businesses at fair prices. This meant looking for companies with an economic moat. Just like a medieval castle, a great business needs an unassailable competitive advantage. Take Coca-Cola. Its century-old brand identity and global distribution network act as a deep defensive barrier. It makes it nearly impossible for a new soda company to steal its market share. With this new philosophy, Buffett slowly phased out Berkshire Hathaway's unprofitable textile operations entirely. He kept the corporate shell and turned it into a holding company designed specifically to house these new, moat-protected investments. Identifying great companies is only half the equation. To scale to the level of a billionaire, knowing what to buy doesn't matter unless you have an enormous pool of capital to buy it. Buffett began acquiring insurance businesses, specifically to gain control over their unique operational cash flow. This visualization shows how insurance float works. Every month, thousands of customers pay their premiums. This money sits in a central pool, waiting for the day a claim is filed. Until then, the insurance company holds the cash. Buffett redirected those billions of dollars in customer premiums to aggressively purchase large shares of grade A companies like American Express and Bank of America. This structure allowed Buffett to invest using other people's money. He shifted from growing his own savings to managing a system where his acquisitions were funded by a continuous, low-cost supply of capital. By deploying this system over decades, Berkshire Hathaway evolved from a failing $7 textile stock into one of the most profitable holding companies on the planet. By the year 2008, it made Warren Buffett the single richest person on Earth. Yet, despite his fortune, he rejects the standard billionaire lifestyle. He still lives in the same Omaha house he bought in the 1950s, drives a modest car, and often picks up a cheap fast food breakfast on his way to the office. His behavioral discipline is entirely opposed to modern Wall Street culture. While financial firms rely on high-frequency trading, complex derivatives, and rapid speculation, Buffett buys dependable companies and holds on to them with decades-long patience. His life proves that long-term financial supremacy doesn't require outsmarting the market every single day. By relentlessly protecting the downside, carefully valuing a company's worth today, and letting time do the heavy lifting, the math will eventually compound in your favor.